What's going on, everybody? It's another week of What the F Happened. And this week, single-handedly, listen, this is going to be the most important episode we do the entire year. So you need to tune in because right now we are seeing the largest bubble in all asset classes, stocks, everything, bonds, real estate, gold. They're all in a global bubble. And we are now peaking for many different indicators and many different patterns. What you're going to see, mark my words, is the next Great Depression. And we're going to tell you how to save your assets from that in this episode. We'll be right back. Welcome back, everybody, to another week of What the F Happened. I am joined with my partner in crime, Mr. Snaggy, Stephen Nagy. What's up today, man?
Hey, good morning. Happy New Year. And we'll see what 2022 has to bring. And we're going to kick it off for you right now this morning.
Absolutely. And folks, just like I said in the intro, I'm going to say it again. You need to pay attention to this. If you got things going on, pause them. This is going to be important because I'm telling you, the economic machine is showing all the signs of what's coming. And what's coming, folks, is the next Great Depression. Don't make any excuses because you know what? Here, I'm going to read something right now. If anyone tells you that this is not a bubble because, shoot first and ask questions later. That is the best way to handle this. Listen, folks, I'm going to tell you something. I study history like a nerd. I study economics. I study the market patterns, and I have for over 20 years now. And what I am seeing right now is like nothing else. But you know what? Forget about me. It's not just what I'm seeing. It's what all the economists are seeing. Everybody from Ray Dalio, the owner and the CEO of the largest hedge fund in the world called Bridgewater Capital is saying this. Warren Buffett, quietly, but he's saying this. Grantham. Okay, Jeremy Grantham saying this. Harry Dent. How about who else, Stephen? We got so many different economists and different professionals.
Yeah. I mean, even Michael Burry, who predicted 08. You got Jeremy Grantham over the ocean there. Even Kevin O'Leary of Shark Tank. Robert Kiyosaki's been talking about it. I mean, we could go on and on.
Yeah, well, what I want to do, everybody, is I want to play a quick video here. So this is a really important video. So we're gonna watch this video just in its beginning stage, and I want you all to really pay attention to this because this is from Ray Dalio, and Ray Dalio is somebody far smarter than Stephen or myself. And not only that, Ray Dalio has spent his entire life talking about this stuff, predicting this stuff, and telling everybody what is going to happen. Now, he has to do it in a different way because he runs the largest hedge fund in the world. But just pay attention to this video and TikTok and come on, listen up, folks. This is important stuff.
Vulnerabilities that existed under the system, and the COVID is a stress test and it'll go away. But there'll be some things that are broken for a long time, and then there's some things that are profoundly changed. I think, first of all, the financial gaps between entities is clear. The rich, the poor, those who have good income statements and good balance sheets, and those have been a defining characteristic. Some of those will be broken, and it has enormous political consequences. The left and the right will be, I think, in greater conflict. And so that issue has also been connected to the changes in money and credit. In other words, before that, interest rates hit zero and there was not classic monetary policy. And also when there was QE, it didn't pass through to those who needed the money most. And we're in a new era in which there's going to be government borrowing money and directing that.
All right, we're going to stop it right there.
We have this entire misunderstanding.
They want to go to a commercial, but what I want you all to understand from that is I want you to understand that is Ray Dalio. Okay, Ray Dalio telling you what is about to happen, folks. And not only is Ray Dalio telling you what is about to happen, all these other people are saying the exact same things. And I'd love to hear your comments on this, but I want to read this right here. Okay, this is from an economic report that just came out on 1/4/2022. Not only are we in the longest lasting, most global bubble ever, it's a bubble in everything. Stocks, bonds, real estate, gold, commodities, and so on. Folks, open your eyes. You see it all. Everything's in a bubble right now. You're seeing it. These things may have peaked at different times. In other words, gold, stocks, bonds, real estate, they're all peaking at different times, but it's all coming to a head right now, 2022. Bubbles of this magnitude only come every other time on my, and this is an economic report, on my 45-year innovation and technology cycle, or every 90 years. So if you study economics, and you study the economic machine and how it works, from simple transactions to the creation of credit to the combination of credit and money. Money is very simply the dollars that we have that we can exchange. And you put that all into the system, it basically shows you very clearly that there is a short-term debt cycle and a long-term debt cycle. Short-term debt cycle is every we'll call it 7 to 10 years. The long-term debt cycle, every 90 to 100 years. And you can give or take a couple years on each of them based on different time periods. But here's the one thing that's happening right now that has really not happened since the Great Depression. And that is all of these cycles, these patterns are converging at almost the exact same time. The 10-year, the 45-year, the 90-year, the technology cycle, like I just mentioned, are all converging right now. Folks, you might not be into economics. You might not care about economics. It is dry, it is boring, but it is the measure, the machine, the thing that always repeats itself. It is a mathematical equation, folks. So like I said earlier, if someone is telling you this is not a bubble because of this, that, or the other thing, shoot first and ask questions later, because they either have something to gain by telling you that we're not in a bubble. So who would have something to gain? Realtors. Are you getting your information from realtors? They make money by selling real estate. So of course, they're going to tell you that there is no bubble in real estate. Or mortgage brokers. Oh, there is no bubble. There's a huge demand. There will be no demand when people lose their jobs, their portfolios drop 30 to 50%. It will dry up. Folks, it's all happened before. You've seen this happen before. Financial advisors, where do they make money? They make money managing your money. So if they tell you that the biggest crash in our lifetimes might be happening this year, well, what does that mean? Well, that means you might not want to have money invested, which means they don't get paid. Folks, logic goes a long way here, folks. Stop looking in the rearview mirror. I can't stand it, Stephen, when people say, yeah, but my portfolio did 25%. I'm killing it this year. Motherfucker, you're looking in the rearview mirror. Did you drive your car looking in the rearview mirror, or did you look out the front windshield to see what's happening next? Because I very much doubt any of you are driving in your car, your truck, or whatever it is you get around in, looking in the rearview mirror. Because you wouldn't be here today. You'd be dead, or you'd be severely injured, sitting in a hospital bed, and you would have taken some people out with you because you are not looking out the front window. What is coming, folks, is purely evident. I can't tell you when. I can't say, oh, it's going to be January. Oh, it's going to be March. Oh, it's going to be the end of the year. Nobody can time the market. That has been proven. Ray Dalio got that wrong many, many years ago, and it almost cost him his entire career because he tried to time the market. But it isn't about timing markets here, folks. It's about greed. It's about FOMO. It's about all the things that make you take action when you're moving and investing your money. Why are you investing money right now? Is it because somebody told you? Is it because you were in an Uber or a Lyft and the Lyft driver said, oh my God, did you see this new coin, or did you see this new stock? It's going to the moon. Every time you hear this, and it doesn't have to be an Uber or a Lyft driver, from anybody, you need to really take a step back and act just like Kennedy Sr. did. And you need to say this: if the shoe shine boy, the Lyft driver, the Uber driver, your friend from work knows more about stocks than I do, now might be the time to exit. And Kennedy did exit in 1929, and that saved his fortune. Because right now, everybody's an expert, because everybody's looking in the rearview mirror, and nobody that I talk to, except for maybe a small percentage of advisors or CFPs or people that really are in the know, understand what is going on. But what is going on is just part of the economic machine. It is something that has always happened. It will always happen. And it is changed by one thing: government involvement. So, Stephen, one thing I really want to talk about today is I want to talk about the myth that people are saying, oh, that's not going to happen again. The markets aren't going to crash again. We're never going to see another 2008. We're never going to see another 1980s, inflationary period. We're never going to see another Great Depression because the government has an unlimited pass to print money. What are your thoughts on that, Stephen? Because I've got some factual data that will tell you why that will backfire, why it is already backfiring right now. You are seeing it, and how, and then we're going to get into how you can prepare. And I want all of you to comment. I want your opinions on this because, hey, this is not going to be an argument, what the F. This is going to be a learning because single-handedly, this episode is the most important episode you will see all year. That is a warning, folks. It is not a suggestion. Stephen, what is your comment on this?
No, I mean, you're spot on. I mean, it all boils down to, what is controlling, what's going on right now and what's driving these markets. And it has a lot to do with, the Fed and what their tricks are. I mean, the Fed is their whole purpose. The Fed, the central bank, is to create jobs and have strong jobs in this country and control inflation. And I saw a really good job report come out this morning. We added like 800,000 jobs or something in December, which is great. I think it was above expectations, whatever that number was. And it's, but when you look at what's going on overall with, what's driving that job growth with everybody laid off because of COVID and the pandemic, I mean, there's just so many different moving pieces. But the bottom line is we've been printing and pumping so much money into the economy through bonds and into the stock markets that is driving all this stuff up. The other trick that they have is to control inflation or interest rates, which are already at zero. So when they have nowhere left to go, they can't print any more money. Inflation is skyrocketing. What happens from there? And I think that's the ultimate question.
So let me just hit a couple things here. TikTok is always full of the haters. So I want to just kind of address a few things, and we're not going to argue today, but one person, Clint223598 says, I want to know how he can time the market. Now, I don't know if he's talking about Dalio or anyone else. Folks, I want to be very clear about something. If you think we're talking about market timing, we are simply not. You can't time the market. It is impossible. You can never, ever time the market. We are talking about planning for an event that is certain to happen. When? That's the unknown. And that is one thing that not me, not Ray Dalio, not Warren Buffett, not Harry Dent, not any of them, Michael Burry cannot tell you when. So this is not market timing. Another person said, they said this last year, though, too. You're right. We've been saying this for years because the patterns don't lie. What does get tricky here, and this is very important, so TikTok, pay attention, is the timing of it. You can't time it. So just like a storm, right? Let's say there's a storm off the coast of Florida, just because Stephen lives in Florida. And the storm is gaining momentum. It's a giant hurricane, and it's gaining momentum. First and foremost, we can't tell you exactly, they cannot tell you exactly where that hurricane is going to go when it's out in the middle of the ocean. It can go a lot of different ways. It might completely miss Florida, but it might devastate another little island. However, does that change the fact that you would plan for that hurricane? If you saw that there was the strongest momentum hurricane out in the middle of the ocean, and there was a chance that might hit Florida, what would you do, Stephen? Would you plan, or would you just be like, honey, it's going to miss us?
Yeah, we have a whole plan in place and we'd be ready to go.
Of course you do. Everybody else does too.
Everyone.
So what I'm talking about, we have a big winter storm hitting Buffalo today. We are planning. Everybody here knows that it's coming, doesn't know when, doesn't know how severe it's going to be. It could altogether miss certain parts of Buffalo, but everybody's planning. So when you're talking about this, folks, I want to be clear. This is not market timing. This is simply the warning. And it's not just me telling you this. And I love it because TikTok is full of haters, and they always say, what are you selling? I'm selling your fucking financial freedom and your financial future. And me selling that, you don't have to buy anything. Everybody thinks that this show is about selling something. There's nothing for sale here. You can keep doing what you're doing. I could give two shits whether or not you keep doing what you're doing.
On the contrary, Chris, after watching this, they might want to sell their stock.
Yeah, exactly. You might want to sell your stock position.
You might want to sell.
We do not manage money. Okay, you cannot pay us to manage your money. We do not have a product, so to say, that we sell. Sure, can you get around the campfire and join us for free webinars? Can you join us for 3-day events? Yeah, I'm not talking about them. This show is about knowledge. This show is about just giving you the facts from what's happening in the market. And that's what
Chris,
what the F happened. Yeah.
Real fast before you go on. I read this morning from an economist that I follow, and he said on money managers, the general system for money management requires people to pretend that they can do something that they can't do and to pretend to like it when they really don't. I think that's a terrible way to spend your life, but it's very well paid. And if you think about that, I mean, it's so true because money managers, most of them don't beat the indexes in the first place, but you're paying them to do so. And they act like they're doing all this stuff to help you and grow your money. But what are they really doing in the long run, right? I mean, it's so funny. It's why I got out of the business. One of the main reasons, at least.
Right. You know, and I just love it. It just keeps coming in after I just told you we're not selling anything. People are like, oh, 5 spots left for some seminar. Dude, just go somewhere else. Like, you obviously don't want to learn. And here's the thing, like, you know, there's no arguing today, period. And some people are like, are you going to spit some, you know, knowledge, or are you just going to rant? No, we're going to rant a little bit because we're here for an hour. And if you're in a fucking hurry, then go somewhere else, because you know what? Building wealth is a marathon, not a sprint. What I'm telling you, if you're in a hurry for me to just tell you exactly what to do, dude, I don't know your needs and goals. So I can't tell you exactly what to do, but I can give you some solid places and solid things that you can do. We're not going to help you do it. Okay? I'm not going to help you invest your money. You should be a good steward of your own money. You should learn these things, and learning takes time. Listen, the successful and the wealthy do 2 things really well. Pay attention, TikTok, all you haters. Pay attention to this very closely. Successful people invest time and they invest money. Okay? You have a choice. Today, you're just investing your time because this didn't cost you anything. So invest your time wisely to learn something new. Even if some of the stuff doesn't apply to you, you might just get the one thing that you need that will catapult you faster, smarter, and more efficiently. Or you could just continue being a hater, continue doing what you're doing, pretend because you're looking in the rearview mirror that everything is peachy. And then you know what? You're going to be fucking broke. So welcome to 2022. This is the time where you all need to make a decision. You need to draw a line in the sand. Are you actually going to get serious about what you're doing? Are you going to start planning for what's about to happen? Or are you just going to bury your head in the sand and pretend this is just going to go over? Because obviously you're too young to have gone through 2008. You didn't understand that. You weren't impacted. Maybe your parents were, but maybe you don't know what this means, folks. Some laughing thing. Okay, so with that being said, let's get into some of the most important stuff. Steven, I'm gonna make my screen minimized here, and I want to just real quick. I want you to pull up one of those things we were talking about here, because I'm done answering stupid questions on TikTok. Because everybody on TikTok, not everybody, there's some awesome people on TikTok. I just had some really good comments come in. But you know, for those of you that want to hate, go ahead and hate, but you don't have to be here. We're not making you be here. This isn't like going to school. You don't have to spend your time here today. And for that matter, like, don't spend your time here. Go somewhere else. Go piss off and do something else. All right. So the one thing I also want to talk about, Stephen, is Harry Dent. We had a newsletter. I kind of had that, but I want to talk about Elon Musk. There's a lot of people out there that love Elon Musk. Some people think he's an alien because he is pretty brilliant. But Elon Musk is saying the same exact thing. He is predicting a recession this year. Now, recession, depression, who knows where it's going to fall. It's pretty difficult to get into a depression because it's just a long-term recession. But let's talk just a little bit about this, Stephen. And I want you to kind of kick this off on what Elon Musk is saying and has been saying. This isn't new. This isn't brand new stuff Elon's saying. Maybe it's more relevant now because Elon Musk obviously sees that it's happening and probably happening sometime this year. So what do you got there?
Yeah, so Elon, this is a few days ago before the New Year's. There was, somebody came out and said there are 936 startups right now valued at more than $1 billion in the world. What do you think this chart looks like in, say, 5 years? Which is a pretty wild statistic in the first place. And Elon commented, if history is any guide, not many will make it past the next recession. So somebody asked him, when do you think the next recession will be? And he simply said, predicting macroeconomics is challenging, which is what we've been saying, talking about how it's hard to time the markets. But Elon went on to say the least, my gut feel is maybe around spring or summer 2022, but not later than 2023.
Wow. All right. So folks, listen, like whether or not you like Elon or not, but I keep hitting the wrong damn button on TikTok. Sorry, you guys. But whether or not you like Elon, whether or not you think he should be making suggestions on macroeconomics, but here's the deal. Elon's a smart guy. Elon isn't on TikTok hating. Elon is out there learning. economist out there that the government listens to. He's actually going in and doing his due diligence, something that, many of you just fail to do because you think you know everything. You have arrived at some level, but Elon has not arrived, never will arrive. Elon is constantly learning. That is why he is so successful, because he will never arrive. He's always pushing to big things, challenging himself, doing the hard stuff, not the easy path. You know what the easy path is? Conform. There you go, Stephen. Conform. Isn't that the easiest path we can all take? Just conform to what somebody else tells us to do. Give up control of our money to somebody else because we think we are not capable or smart enough to be a good steward of our money, the tool that drives this economic machine. But you know what? He is smart enough to go out there and learn. And if an economist, a leading economist, says something like, hey, 2022 might be the year when this all goes down. And we're going to get into some of the reasons so you can understand this, whether or not you want to understand this. It's important that you understand why we are at this point right now, not just somebody saying we're there. There's factual data that proves that we are there, but you got to spend some time to understand this. But before that, I just want to give you one more here. Michael Burry. Stephen, you love this guy because this guy predicted 2008, and there's a movie about him called The Great Short. And there you go. Jeremy Grantham is somebody I follow, top investors. Like, listen, this isn't me. This is on the news. What do you got, Stephen?
Millionaire investors, Leon Cooperman, Stanley Druckenmiller, Jeffrey Gunlock, Shark Tank's Kevin O'Leary, Gary Schilling, Rich Dad's Robert Kiyosaki. I mean, the list goes on, and they're all giving their, what they've said in the last 3 to 6 months or so, fully fledged epic bubble. This is going to be the real McCoy when you have reached, so they're starting to sound the alarm. And, one thing I find interesting is we are starting to see more and more of people coming out and talking about how this is a bubble, how they're expecting a major crash. And where that differs a lot from the past is, leading up to the 1929 Great Depression, there was really nobody saying that was going to happen. Nobody expected it. I mean, like you said, the shoe shine boys were all talking about how great everything is and so on and so forth. And, 08, I watched a compilation recently of about 3 months leading into when the Lehman Brothers collapsed and 08 really kicked off and happened. And I mean, it was just professional and expert and talking head and economist after another over and over the 3 months leading up to that collapse saying everything's great. There's no problems. Janet Yellen was out there saying everything's perfect. There's nothing to worry about. So, and then we had 08, which was a pretty major problem, and the Fed saved us. But one of the big things I see different now is so many more people are talking about it. And the Fed right now, though, has already used all of its tricks that helped us get out of 08 and recover from that. They've already used all that to get us out of the pandemic. So now when we have everything that's about to collapse again and the Fed is out of tricks, what the hell do we do? And I think that's why a lot of people say we're going to see this depression or recession as opposed to just a short-term downfall and then recovery very quickly. Why it's going to probably be longer because we are out of tricks. So that's what I want to talk about.
So here's the thing, folks, and I'm not going to go deep into this, but there's a great video on YouTube that you should all watch. It's old, okay, which is okay. It was created in 2014. It's not relevant for telling you, that the market, all the stuff that we're talking about here. It's relevant for you to learn and understand the economic cycles and what creates them and how the economic machine works. And Ray Dalio created a great video. And, Stephen, if you can put it in the chat here and TikTok and Instagram, just maybe write this down. It's called The Economic Machine. It's a video that Ray Dalio did in 2014 that explains how the economy and the economic cycles all happen. And it starts with transactions, then cycles, then short-term debt curves, long-term debt curves. This is all stuff I learned as a financial advisor in the Series 7 book and many other things. And also by studying economics, which many people obviously wouldn't do because it is a dry and boring topic. But by studying this, you start to see the picture of what is happening. And then once you understand the picture, I think where I'm really good is then taking that picture, that global or that macroeconomic picture, and then telling you what are the signs today that prove where we're at. Well, I want everybody to, everybody knows this because most of you probably watch the news, which is kind of silly to me because the news is more fake than it is anything else. But when you actually look at the news, you hear nothing but inflation. Okay, where is inflation? Is it 6.2? Is it 6.8? Or is it more? Well, if you factor in food and you factor in gas into the number, it's way higher than that. But we all can agree, because you've seen it on the news and because the government has come out and said it, we are above 6% and climbing. And why is that? Well, because when you look at an economy, it is made up of two things. Credit, well, it's made up of transactions, which technically are credit and money. Okay. So money, and when I say money, I want to be very clear. Money is nothing more than a means of exchange. The only thing that we can technically exchange by definition in this country is legal tender, the US dollar. Okay. And if you live somewhere else, if you're in UK, everybody has their own legal tender, but that is what you can exchange for bread, for food, and everything else. So when you look at the global picture and you try to figure out, all right, what is the total global economy? Like, how do you come up with that? Well, it is quite simple. And I have some notes here to kind of explain that, but it is consisting of credit and it is consisting of money. Credit is more complicated and credit is the largest of that. Right here, Stephen, it's got it up on the screen. Okay, so if credit is the largest thing, how would we fully understand credit? Well, credit, number one, is volatile, okay, because there's short-term debt cycles, there's long-term debt cycles, but it's very volatile. And it's the biggest, but lenders want their money to work for them. So let's just start with lenders. You all have gone to the bank. They want their money to work for them. That's why we always teach become your own bank, because we are teaching you how to mimic what a bank does day in and day out. And banks want to make their money go to work for them. And they do that in the form of lending. So they lend that money out to credit-worthy investors or credit-worthy people. And in doing so, that is basically how they make money. And the borrowers need that money to buy things that either they need or don't need, or start businesses or get working capital. So when you use credit to buy the things you can't afford, you start to create problems. These problems have been in existence since the early 2000s, escalated in 2008 because of the stimulus, the printing that they did, which, just so everybody knows, I don't know if everybody knows the numbers. You know, when you look at today, because of coronavirus, the government has printed, the government and the Fed, which is different than the government, have printed over $5 trillion. Did you realize that in 2008, okay, or, you know, when the market melted down for the Great Recession, they only printed, and here I have the number here, they printed far less than that. Where is it? Okay, here we go. They printed 3.6 trillion. And at that time, that was a monumental amount of money. That was like a record. They'd never printed more. Now we've printed 5 trillion. And we're not even in a global recession, or are we? Because they print a lot of money because it's called modern monetary theory. And I love that some people were calling me out because I called Michael Burry's movie wrong. You know, it's The Big Short. I don't remember what I called it. Sometimes when I'm talking, my thoughts are ahead of what I'm saying. I have watched The Big Short over, I think 5 times now I've watched it, and I will continue to keep watching it. So great call, guys. But here's the thing. To figure out the total amount of money, you would basically have to do a calculation. And that calculation should take the total spending, okay, and the total spending, which is dollars and credits spent, and then you divide that by the total amount spent, and that basically gives you the quantity sold, okay, and then you divide that, and it gives you the price. So whether or not that matters, that's essentially what this whole thing does. So when you talk about the economic cycle, I already kind of mentioned it. You now have all these different cycles coming to a head. The long-term debt cycle is there. Inflation is running rampant. But one thing that is important to understand about inflation is not that it's over 6%, folks. And Stephen's putting it up on the screen. I want you to understand inflation as a contributing factor of the government printing money. Inflation is not so much just the fact that your goods and services go up in price. Inflation is a hidden tax. The government drives and wants inflation because inflation weakens the US dollar, which makes the US government in a power position because then they can pay back debts at lower valuations. Does that make sense? If they inflate, things, if they create inflation, a hidden tax, because it's stealing money from you. Without you having to do anything and without the government having to do anything, they print money, they put it into the economy in the form of assets, because most of the money flows through banks or Wall Street, creating bubbles. You give people money, which then they go out and spend, which keeps that economic machine turning and working. Right here, we're talking about the debt burden. And eventually what you have is you have more debt than you have the ability to pay that debt. And then there's a breaking point, which is called the deleveraging period, where the government is trying to balance the different things, which is the income that people have versus the debt load. And it's a delicate balance. It's a very difficult balance to actually get right. And they are not getting it right. And you are seeing that happen right now. So what are you seeing right now? Well, you're seeing the government, they gave stimulus checks. That's putting money printed out of thin air back into the economy so that it stimulates the economy, which it did. That worked, Then what did they do next? They put money into bond buying programs, trillions, if not, well, billions, which turn into trillions of dollars of bond buying, which pumps up the Wall Street side, okay? Pumps up the markets, puts money into financial assets, increasing stocks. Has anyone really taken some time to fundamentally look at the stocks that you're buying? Have you fundamentally analyzed any stocks that you have bought inside your 401k, your IRA, or your brokerage accounts? Probably not. Have you even read the prospectus to understand what you're buying? Because, some of the laws of wealth are that you should only invest in things that you know, like, and understand through knowledge, okay, through time, and through your due diligence. But how many of you actually do that? You don't. You get your advice from people that probably know nothing more than you do, if not less than you do, because somebody says, oh, you should buy this NFT, you should buy this crypto. I'm not saying anything's bad about NFTs or cryptos, but I'm just simply saying, how are you getting your information to make decisions? Maybe you're giving your money to an advisor. Maybe the advisor is a fiduciary. And if that's the case, good. Then they're probably giving you more solid advice because they have a fiduciary responsibility or fiducial responsibility to make prudent suggestions and recommendations to you based on your needs and goals. But does everybody else have your needs and goals in forefront? I don't know. Because a lot of people put themselves before your needs and goals. And in doing so, they're giving you advice that pays them, that makes them money. And it may or may not make you money. So when all this happens, you keep printing money, you keep pumping it in, you keep increasing assets. What happens? You make the economy go faster and faster, which also then drives inflation. But here's the one thing that's supposed to curb inflation, which you're hearing the government talk about this, but they're very leery about it because, as history would say, Japan painted the picture. They are trying to raise interest rates, but Wall Street is saying, no, don't raise interest rates, because they understand if you raise interest rates to curb inflation, which is one of the number one ways that you are going to curb inflation going out of control, or what they call hyperinflation, is to raise interest rates. But if you raise interest rates, you upset the delicate economy that we are in right now. If they raise interest rates, are people going to be rushing out to buy houses to pay way too much money for the housing that they're buying today? Are people going to rush out to buy brand new cars or used cars, which are in a crazy bubble, a speculative bubble? If money cost more, would you keep buying? No. Okay, that's the whole thing with the economics. So as interest rates go up, you slow down the need or the demand for people wanting to borrow money because it just costs more. This is the balance. Well, we are at that point now, folks. We are on the verge of hyperinflation. Inflation's running out of control. And because inflation's running out of control, the Fed and the US government knows they have to do something to curb this. Okay, what can they do? Well, they can do a lot of things, but starting with interest rates, they can raise interest rates, make it more expensive for you and for businesses to borrow money, which slows things down, which brings inflation down. Just look at these late 70s, early 80s. That will tell you how that happened. Then what they can also do is they can slow down the bond buyback programs, okay, which then pulls money out of the system, i.e. Wall Street, which then continues to curb that inflationary pressure. Inflation is hitting everything right now. It's hitting your real estate. It's hitting your stocks. It's hitting your groceries. It's hitting your gas. You're seeing it all around you. Okay, the asset bubbles are crazy. You fundamentally cannot really justify any stocks, maybe a couple pharmaceuticals and medical stocks, but fundamentally nothing makes sense. Elon will say that. Warren isn't buying anything because fundamentally nothing makes sense to buy. They are bottom feeders. Michael Burry is telling you the same thing. So folks, listen, if the big guys, if the big money are telling you what's happening, if the big money's actions are telling you exactly that they are not buying, they are being cautious, they are going to cash, they are moving money to U.S. Treasury bonds. And if you really look deeply, if you want to look at where banks are putting their money, guess what the banks buy, folks? And you don't need to take my word for this, but I will tell you, banks are the number one purchasers of whole life insurance in the world. Guess what they're doing? Increasing the amount of BOLI that they're putting their money into. Why? Because whole life insurance is backed by giant mutually owned insurance companies, which are very strong financial institutions, far stronger than banks. Banks know this, which is why they put their tier one capital in insurance companies. And the only way to get your money into an insurance company, just so you know, mutually owned insurance companies, is through this product called Whole Life. But the product called Whole Life isn't what you think. It's designed totally different. Okay, it's kind of like private placement life insurance. If any of you are smart enough to understand that, it eliminates a lot of the commissions, if not all the commissions, by going direct to the source, by building the machine, the whole life, differently. You see, I'm not telling you this because I'm telling you to go buy whole life. I'm telling you this because this is what banks do. This is what large corporations do. This is what the wealthy do. A lot of the wealthy's money right now is sitting in privatized banking systems. You probably don't even understand what that means, so you just ignore it. But all these reasons and all these things that you can see demonstrated by what's happening with the wealthy, what's happening with the banks, what's happening with large corporations is a telltale sign that we are at the end of a cycle. And the next part is deleveraging, which is already happening. Following deleveraging is a delicate balance of the government trying to manage this economic cycle and kick the can further because nobody wants an economic crash, including the government. It's bad for votes. So if this administration has the market fall out from underneath them, who's going to vote for them to come back in when they failed at the economy? Nobody. Do you understand? Like, this is just logic, folks. I'm not even telling you anything that needs to be, complicated. This is just simple logic, and it's happening right under your nose. You can see it. You can go out in the grocery store. You can see all of this happening, all of it right under your nose. So the question comes down to, logically, why are you not paying attention? Why are you not planning and preparing for the storm that's about to come? Is it because you're saying, oh, you can't time the market? I'm just going to try to squeak out the last little gains I can get. You will lose. Mark my words. From an advisor of 16 years, from somebody that is an avid studier of history and economics, you will lose the bet. Okay? There's no two ways about it. You will be the loser in that equation, because the markets will fall out faster than you can react. Maybe if you're a trader and you're hedged in your positions of stocks, okay, which, hey, listen, some people on TikTok were asking me, well, what are you talking about? Stocks, crypto, or everything? I'm talking about everything, folks. I will personally tell you, and Stephen can comment on this, I have zero money in the stock market right now. I have lots of money in privatized banking. I have lots of private loans that I do in a first lien position. I am my own bank, so all the things that I buy through my banking system and pay my banking system back. I own a lot of U.S. Treasury bonds, but specifically 20 and 30-year U.S. Treasury bonds, because I understand the inverse relationships to interest rates. Most people would look at U.S. Treasuries, they'd pull up a chart, and they'd say, you're an idiot for buying that. Why? I'm an idiot because it's going down? Well, yeah, why would you buy something that goes down? Holy fuck. Then I got to ask you, are you really asking that question? Because isn't the name of the game in investing buy low, sell high, and don't lose money? But yet everybody wants to buy high, sell low, and lose money because it feels good. Well, folks, I don't want to feel good. I want to become wealthy. And I want to help a lot of people become wealthy by being ready, by planning. And by planning, that means I got to be patient. And I got to just sit back and wait because, hey, nobody can time this motherfucker. You can't, Ray Dalio can't, Warren Buffett can't, Schiff can't, Burry can't, but Burry has strategies he's putting in place. He's planning, and he's smarter than you. He's smarter than me. Stephen, what do we got from article standpoint? Because I'm going on a rant, but I'm trying to get you all to understand. I just threw you a bunch of what to do's, okay? A bunch of things, all from the all seasons portfolio. Ray Dalio came up with a portfolio suggestion, and he modifies it. He changes it based on economic conditions. Look it up. Look it up. How much money is Ray Dalio suggesting that you put in, and he doesn't so much call them U.S. Treasuries, or I think he actually might. How much is he putting in U.S. Treasuries and AAA rated corporate bonds? Look it up. You don't need to take my advice, because what do I know, right? TikTok will say that I'm doing nothing but scamming because I'm selling something. Folks, there's nothing for sale here. There is your financial future at stake. So when you ask what is for sale, that's what's for sale. Your financial future, your family's financial future. So get ready. Because if you think I'm selling you something, maybe you should be fucking buying and listening, because you're going to be the loser. And that's all there is to it. Stephen, what do you got to say? Because
everything you're saying is just backed up by what is being said by the government and the Federal Reserve. I mean, here's the Fed clears path for multiple rate hikes during election year 2022 as prices surge. The Fed plans to seize its bond buys entirely by March. So they're stopping pumping the money in and buying everything back, basically giving the government money. So the way that this works, just to kind of clarify a little bit, is the Fed, the central bank, is completely independent of the federal government, because the Fed is not allowed to directly purchase assets, although that's a whole nother discussion whether they're doing that or not. And the federal government's not allowed to print money, but the Fed can print money and the government can buy things. So they have to work together. So the Fed's been basically printing the money and then giving the money to the government through bond purchases. And that's what's been keeping this whole thing propped up and the bubble continuing to expand and grow the way that it is. But they're coming out now saying, you know, the Federal Reserve on Wednesday, this was 3 weeks ago, December 15th, said it will speed up the timeline for ending its extraordinary aid to the economy. It's unprecedented. A likely first step towards raising interest rates during the 2022 election year to help fend off heightened inflation. The move marks a striking turnaround for Fed Chair Jerome Powell, who only months ago was dismissing the surge in inflation as transitory.
Yeah,
so there
that
exactly
word,
what you're saying.
it was really transitory. It's just interesting because, you know, if you really pay attention, most people aren't. They're taking what they're getting fed through the news stations, and they're only taking it at face value for that particular time. They're forgetting that the Fed has changed their ideas. The Fed has changed their decisions, and the Fed has changed what they said. I can't even count how many times. Does anyone on YouTube or Facebook or TikTok or Instagram know how many times has the Fed changed their opinion on this economy and inflation in the last year? Can anyone tell me? I bet you can't, because you probably can't even count. I don't know. It's insane. And, you know, Stephen, one other thing I really want to hit, because this is a very controversial thing. And this show is about what the F happened in the markets in the week in review. And there's always a lot of talk about real estate. And listen, like, I'm going to be the first person to tell all of you this. I firsthand think that real estate is the single greatest investment of all time. I think there is no better investment than real estate because, number one, real estate is tangible. Number two, real estate has many exit strategies. Number three, real estate is something people will always need because people need shelter. It is one of the mandatory things we all need to survive, along with food and water and some of the other things. But shelter is one. So therefore, I think real estate is the greatest investment of all time. But where I think people fuck up is they don't understand how to make money in real estate. It's not that real estate's a bad investment in any economic cycle. It's not. It wasn't a bad investment in 2008, 9, 10. It's not a bad investment now. It's not going to be a bad investment in the future. But there is a right way and a wrong way to invest in real estate. And I will tell you this, and you can take this from history. If the whole market melts down, which it will, okay, meaning the stock market. When the stock market goes, real estate will follow in about 6 to 12 months. 12 months is probably unlikely. It's not going to take that long. I would even doubt that it's going to take 6 months for real estate to follow the curve of the market going down. But you're already seeing, folks. You're just not seeing it because you're just looking. When we look at things, we look at it as a long period of time. When you're looking at things and when the news is looking at it, you're looking at a microscopic little view of a big picture, which is why you're not seeing the whole picture. Okay. And you know, that video, that the economic cycle or the economic machine shows you that, how we look at things and how economists and fund managers like Ray Dalio and all of them look at things. They look at the macro view, like Elon said. But the whole idea is with real estate, I see a ton of people. I hear about it. I mean, I'm a big flipper. We flipped 200. Right now we have 2 flips, technically 3 flips under construction in the final stages. And that will make us hit 270 flips that we've done between me and my wife. 270 flips. Okay. That's a lot of flips. It's a lot of gray hair. And if you really pay attention to my hairline, like, I'm starting to lose some hair. I'm working on it, folks. I'm working on it, but just in full transparency, like, that business is stressful. But everybody right now is plowing into real estate to flip because they want that quick money. They want that FOMO. Oh my God, I'm going to miss out. Well, I'm not saying flipping isn't a solid way to make money in real estate, but I would say you missed the curve. I would say you should have been flipping several years ago, but people are like, no, but real estate's so high right now. Yes, but you're paying a lot and you're selling it for a lot. You are speculating. You are playing a speculative game that eventually will end because when the markets drop, real estate values will drop. You're already seeing demand for real estate fall. You're seeing new home builders building less homes than they did last year. You're seeing interest rates tick up slightly, not a lot, because it's a delicate balance the government's playing with this deleveraging process. But all I'm telling you is if your strategy is flipping, don't get left with the bag. Don't be the last one holding the real estate because that's where you're going to get burned. If you're playing the speculative game, if you're playing it saying, oh, I'm going to overpay. I went out. Yes, I overpaid for the property, but the market's going up. So I'm going to be able to sell it at this price. If you're playing the game of your money that you're going to make is based on the amount you're going to be able to sell it for, you are doing real estate all wrong. Stephen knows this probably better than almost anybody. Money in real estate is made on the buy, especially in the flipping game. It doesn't even matter what you sell the house for. All the money is made the day you buy the property. And it is all determinant on whether or not you bought the property right. But then the tricky part is, well, what's the right price, Chris? How do you do that? Well, that's very difficult. The way we used to fundamentally look at the pricing for real estate really doesn't work today. However, that's still the way that I buy real estate, because I am not going to change my modeling to pay extra for real estate just to get in the game. I can put my money other places. I can give my money to any of you and lend it to you in a first lien position. If you're a viable, credit-worthy borrower, I will lend you money for your deals, and you will pay me 12% interest on that, and I will be in control. You think you're in control because you're there swinging hammers and driving the direction of where that flip goes. If I'm the lender, if I'm the bank, I'm in control. Because if you don't pay me, I take your property. If you don't, if you want to exit that property through a refinance or through a sale, I get paid first. If you're not first, you're last first, folks.
Yeah.
So the rules I apply.
Chris, one thing I'll add to that too, like in the private money club, for example, we have a lot of borrowers in there that are, presenting properties and deals to our lenders in there so they can make those connections and make the deal happen and everybody wins. And whenever I talk to a new borrower, or any borrower for that matter, that has a deal, any new investor, any real estate flipper, whoever they are, somebody buying real estate, I always ask them the same question, because they always want to tell you, this is how I'm going to make money. This is how much I'm going to sell it for. This is my exit strategy. I'm going to flip it. I'm going to turn it into an Airbnb. I'm going to make this much each week, or I'm going to do it in a long-term rental. I'm going to make this much on an annual lease or whatever, right? They always want to tell you about how they're going to make money on the deal. I don't give a shit about that. I want to know, how are you buying that deal? Because if you're new to investing, you might be taking more risk out there thinking you're getting a good deal because you're new to this game, and this market we live in the last few years is crazy, right? But if you've been in the game for, let's say, 10 years or longer, you understand what we're going through right now, and that deals are not easy to find. And so what I do is I ask them, whether they're new, what's your strategy for buying properties? And what they tell me over the next couple paragraphs from there tells me everything I need to know whether I want to do business with them or not. Because if they have a strategy, they tell me, listen, we've had to pivot from the Dallas market to the North Carolina market to these small areas because these are the types of homes that fit our strategy for our numbers to make these deals work. They know what they're talking about. But if I talk to somebody who's like, yeah, I live in Tennessee and I'm buying here because I live here and I think there's some good deals around and stuff like that, you have no idea what you're talking about. So that's always where I go to first.
And I like it. Johan Norris here on TikTok said some interesting things. So, he's saying, where he lives, he rents out rooms or rents out the lower suites. Like, that's brilliant. Like, they call that house hacking. I believe Bigger Pockets kind of coined that theme. And that's brilliant. If you're a new home buyer, buy a duplex. Do it with an FHA loan where you don't have to come out of pocket with much money, because interest rates are low. So I certainly say there's good debt and bad debt, and good debt is low interest rate debt that you can then leverage to make money. And if you're house hacking like Johan is here, or in a roundabout way, you can Airbnb, that other unit. You can Airbnb bedrooms. Today's a much easier environment than it used to be for us, Stephen. We didn't even have Airbnb back in the day when we were doing all those flips and the rentals. But, it's interesting because that's a really smart way. It's an exit strategy, but it's a great way to make some extra cash on properties or on space that you're not using, like extra bedrooms or suites or things like that. So Johan, good job with that, man. And, everybody that understands real estate understands that the money's made in the buy. I'm not telling you anything new. I'm not trying to be the guru expert in real estate. Matter of fact, if you want a guru expert, I'll send you to somebody else. Like, I've done a lot of real estate. Steven's done a lot of real estate. We've combined between the two of us. I don't even know how many rental units we've owned. I've been selling my rentals off. I'm down to 14 properties right now. Man, that is a win. Some people are like, you're an idiot. Like, why would you be happy that you're down? Because I've been selling when the market's been going up. So I've been selling into an increasing market, making a silly amount of money. Then I take the money that I make on the real estate that I sell, and what do? I move that. I move it. I make it go to work for me. I lend it. I do different things. I become the bank with the money, and I am in first lien position on everything I do. So I control everything, and I don't have to own anything. I had 91 rentals prior to COVID. 91. All I can tell you is that was a pain in my ass. When COVID hit, it made me a miserable, nasty son of a bitch because people stopped paying. It was a really difficult time. And part of the reason I'm selling off is because I'm just so sick to death of dealing with tenants that think they're owed something. Like, I should just give them free housing because of this or that, or because of the moratorium, because they don't have to pay. I don't want to deal with it. I don't want to own shit anymore. I want to control shit. And doing that has changed my life. It has made me much happier. It has provided me freedom. Now, what is freedom? Some people say, oh, financial freedom. Well, freedom is time. Money and financials create time. Rentals take time from me. Lending, dude, you don't pay me, for the loan that I made you. I just start the foreclosure process. And that doesn't take any more time than me sending an email to the attorneys. They do it all. So I'm just trying to get you to understand that. But here's another thing. I want to get to some factual numbers. So we've got some charts here, some data here that I want all of you to do.
I'm going to pull this up, Chris. I'm going to pull this up.
But I'm just going to read it. Experts keep saying that this housing bubble is not as bad as the first one, i.e. 2008. I showed in the January issue, and this is an economic report, that home prices adjusted for inflation are now 6% higher than they were in the 2006 peak. And real estate was way overpriced in 2006. Do y'all think that? Remember how much real estate sold off, like 40%? So obviously real estate was really high in 2006 peak, and it's 6% higher today. The median home sale price right now, and I don't know where it is, it's in the 400,000 range. I live in Buffalo, New York, man. Nobody wants to live here. Prices of housing here is silly. For a place that like snows, it's gray, it rains, it's miserable. People have shitty attitudes in the most place. I don't care. Like if you're from Buffalo and you don't like what I'm saying, people are friendly here, but they got a broken fucking mindset because everybody is so negative. And TikTok is kind of the same. A lot of people on TikTok are very negative. You must live in Buffalo. I don't know. But the home prices to income ratio are even more. So right now, the home price to income ratio is higher than it was in the last bubble. And I think that's the more important aspect of this. Stephen, what are the charts that you're holding up there? Let's talk about those ones here real quick. And let me show TikTok this, and then I'm going to hit some questions on gold because, everybody knows gold and precious metals as being, the thing you buy when the markets go down. So I do want to hit that.
Yeah, so this is just talking about this, the top 100 markets in this second great bubble that we're in right now for housing. And it's talking about how basically you can put these different markets into three different categories. So those three different categories would consist of those markets that went higher in this bubble versus the first bubble. The first bubble we're talking about was leading up to 08, so 2005, leading into 2008. And then the collapse from 2008 into 2010, 11, and then the recovery, and then the bubble now that we're in again. Number two would be those that went higher in the first bubble compared to this one. And the number three is those that had similar bubbles both times. So just as an example, you can look at Dallas here. They didn't, if you look at 05 going into 2008, they didn't really have a bubble. It was pretty consistent with the long-term growth chart that we expected. And you can see it didn't really ever go much above. They did come down a little bit like everywhere, but as far as the bubble goes, they didn't have much. But now you can see what's happening over the last few years. We have a huge bubble going on now for Dallas. If you look at Atlanta, they had more of a moderate bubble in 2005 to 2008. So you can see they went above and they had a decent decline, but you can see right now they're really just taking off again. As far as the current
that's
bubble.
Insane. Look at that
And
curve. It's a hockey stick, folks.
Yeah, it really is incredible what's going on. And then you can see one of the stronger bubbles last time, something like New York or Miami, where you had a huge spike and then the big downturn. And now you can see it's not quite as steep. You can see over the last year or so, we've really hit it. But leading up to the last year or so, but what happened in the last year or so again, Chris? Well, we've been talking about this whole show. The Fed pumped all the money in, created all the credit, gave zero interest rate environment, cheap money, and everybody's starting to confuse credit with actual money. So when you have that, people are buying homes because they're able to do so for very, very cheap, and it creates these bubbles. And that's what you've seen over the last year or so in places like New York and Miami. And I really think what led to a lot of that, Chris, and I haven't, I don't know if he mentions this, but I think places like this learned a little bit 10 years ago or 12, 13 years ago in 2008. They learned, hey, this is what can happen. Look at Miami and Florida. Hey, this is what can happen. But I just think the flow of, and it's kind of funny to see.
It's getting there, but that's just supply and demand right there.
Right. I mean, it's just crazy. But, they took it easy for a long time. Hey, we're not going to get into another bubble, but money's so cheap right now, supply and demand, just boom. I mean, there's nowhere you can go. I mean, look at Chicago. Boom.
So let's just get to some tangible, actionable items in real estate. So if you're playing in the real estate game, the biggest things I would say is focus on the buy. And there's a lot of people on here. I'm looking at just some of the people. You guys are really good at real estate. There's a lot of really good real estate investors on here, and they all know focus on the buy. Don't fall into FOMO. Don't think that you're missing out on something. Wait, be patient for the right deal. The 2 deals that we just bought, I'm not even looking for deals. I'm not marketing. I'm not putting anything out there. When the right deal came across my desk, it was brought by an attorney. I did my math, my calculation, and it fell right in line. But some would say that was luck. You can call it luck. I say that luck follows.
Well, time out real fast. Chris,
yeah,
actionable items you're talking about, that deal came to you because of networking, because of relationships, because of the business you've built over the last 5-10 years. So that's what business. It's not about marketing. What's now. It's long-term relationships. But go ahead.
Yeah, you're absolutely correct. I mean, you almost, when you look at like, where do you invest money? Where do you put time? What do you invest in? I would say one of the most important things to invest time, money, and everything else in is relationships. It is the one thing that will continue to pay you. It was the one thing that will continue to serve others. Relationships are almost priceless. So, when I look at what I do, I hate, the title that people gave me of America's #1 money mentor. That's great. But you know what? I'm a student. I'm always learning. On weekends, when my 19-month-old, takes nappy, we call it, when she goes down for nappy time or milky, I watch videos. Folks, I don't know everything. I might know a lot more than most, and I might know how to explain it a lot better than most people in actual 5th grade language, but I'm a perpetual student. I will never, ever arrive. I will never be the person that knows everything. I am always willing to learn from every one of you on TikTok, every one of you on Instagram, every one of you on Facebook, on YouTube. Like, I'm a perpetual student, and you should be too. And you should invest in relationships and invest in yourself. There's no better investment you will ever make than in yourself. But too many people don't value themselves enough to invest money in themselves. But okay, if you don't have money, invest time. Time is the most precious thing you have. There is no value on time. You can't put a value to your time. It's priceless. But you do put a value on your time because you are out there every day trading hours for dollars. So when it comes to real estate, pick the right strategy. If you're brand new, if you're a millennial or young and you're looking at buying your first property, look up house hacking. Use FHA loans. Leverage low interest rate mortgages right now, but do it in a sense where it's mathematically proven by you. By you actually say, all right, if I buy this duplex or I buy this house and I rent out the lower or upper unit or side by side, whatever it is, or I rent out or Airbnb one of the bedrooms, is somebody else paying my mortgage for me? Am I living free, or am I living free and making beer money? That's a great way to do it. Okay, if you're an experienced investor, spend a lot of time right now focused on long-term rentals, because the rentals aren't going to be affected in a downturn. Maybe initially they'll be squeezed because people will kind of have that period like they did during COVID where they don't have the money, but eventually housing will become a very important thing. But don't buy high AAA, like don't buy the A properties, buy B's and C's, because those are going to be the affordable living that people are going to need. Right now, they might be wanting the lofts and the $5,000 rents, but I'll tell you, when the whole thing collapses, they're not going to want those. There's going to be a lot of vacancies there, and that pricing is going to be driven down because there won't be demand for those. There will be demand for your B's and C's. So even if you are overpaying for real estate right now, because that's the market, that's the environment we're in. Maybe you don't have patience and you have money you need to deploy and you're buying real estate, fine. If you're overpaying for it, understand one thing. You better be playing the long game. Play the rental game, the spread, if you will. How much is it costing me to operate and own this property versus how much am I bringing in? What's the spread? And then stress test it. If your rents drop 10%, are you still making money? If they drop 20%, are you still making money? If they drop 30%, are you still making money? Those are your metrics on how you should be looking at. But literally, if you're playing the real estate game based on speculation of price increases, you are going to lose the game. And guess who's going to come in and save the day? Me and Steven and the smart real estate investors on here, because I'm going to come in and clean up your fucking mess by buying your property at far less than you paid for it because you can't keep it because you fucked up. I hate to say that. You might say, oh, that's a nasty way. But you know what? Be greedy when others are fearful. Everybody's greedy right now, so I am fearful. I'm not looking to buy. I don't want to buy. I don't want to be in the markets. Hell, people are like, oh, what are you doing, sitting in cash? No, but I would. I don't think cash is a bad thing. Oh, but inflation's destroying it. Why? For the next year, I'm going to lose to inflation? Really? Is that worse than me losing 30 to 50% by rushing into an asset like the stock market? And when it goes down, you miss the boat and you lose all your money? Logic, folks. I'm the bank. That's it. I teach BYOB, be your own banker. That's what we teach. Okay. You don't need to pay me to teach you that. It's free. There you go, TikTokers. It's free. Learn. And you know what? Nothing in life is free, because you know what it will take for you to learn? Time. It is the most expensive thing you have. So is what we do free? Absolutely not. It's going to take your time, which means you are going to pay more than anything to learn, because your time is priceless. All right, if you like that video, make sure you check out this video right now. And also don't forget, subscribe to my channel, and don't ever forget to smash that alert button. We'll see you on the next one.